and welcome to my live webinar. I am Kyle Ashcraft, founder of Maxwell CPA Review. And today we're going to talk about a BEC topic, which is IT. So we're going to talk about different terms here. We're going to talk about audit data analytics. We're going to talk about big data. And we're going to talk through the transaction processing controls versus the IT controls. And we're going to go through a few different examples as well. So without further ado, let's start going through some of this material here. And we're just going to jump into the content here. So the first thing that we need to talk about are the different kinds of systems that we have within BEC. So you could start memorizing all of these different systems, but it's not going to be really useful for you because they all sound similar. They're hard to memorize. So what I would suggest instead is to create two major categories for how you memorize these terms. So this first major category that you should have is for these decision-making systems. So this is the first major category. So within this category, we are making decisions. So the information that we are looking for is to help us make strategic decisions. So you're going to notice that all of the names of these kinds of systems are pretty similar. So we have a management information system, decision support system. So it has these kinds of words to show us that it's for the high-level employees of the organization to take this information and to then make decisions about the future of the company. So all of these go under the decision-making systems category. So if you see the word executive or if you see the word management, it's going to be under this decision-making system. So that's the first category, decision-making systems. And the next question is, what are the transaction processing systems? So let's take a look at them here. So transaction processing systems, they're not helping you to make a decision like the prior category. Instead, they're helping you to make a process become more efficient. So you're just trying to complete something more efficiently, more quickly, with fewer resources. That is what the transaction processing systems are focusing on. So the first kind of transaction processing system is called an accounting information system. Now, this is simply any kind of accounting system that you use for your business. So if you're using QuickBooks for your business, then that is what we're talking about here. QuickBooks is an accounting information system. So it's simply software for the functions of accounting. It's going to help you to complete routines more efficiently. So the focus, once again, is about efficiency, not about decision making. And with the accounting information system, we get to create an audit trail because it helps us to track the different transactions that the company has had. And it helps us with preventative controls, which we will talk about. So that's the first kind of transaction processing system, an accounting information system. So now let's take a look at the next kind, which is called a customer relationship management system, a CRM system. Now, this is all about tracking your interactions with your customers and potential customers. So if you have a customer and they call and leave a complaint call, you're going to record what they said into this CRM system. That way you could maybe tailor how you communicate with them based on what you have for them in your notes. So a great example of a CRM system is Salesforce, because it's a software that helps you keep track of the interactions with the customers. So this is a CRM system. And next, let's talk about a more important term, which is enterprise resource planning system. You're going to see this term come up pretty often on the IT section. So it's really important to understand. And this visual here is going to help us understand it just a little bit better. So at a high level, an ERP system helps us to centralize and integrate the departments in our company to provide quality information. So let's take a step back for a moment. Let's think about if we had a manufacturer that sells beds. So this company is manufacturing the beds, they are storing the beds, they are shipping the beds. So they have all these different departments that are keeping track of what's happening. And if you don't have an ERP system, then each individual department has its own software. So they're going to be using all these different decentralized softwares to track the activity. But if you just use one ERP system, then you can integrate everything together so then all of your departments communicate with each other. So for example, here, if you implement an ERP system, then when someone orders the bed, it's going to automatically communicate to the accounting department so they can record the sales revenue. It's going to communicate to the warehouse department so they can pull it from the rack and then ship it. So that's the purpose of an ERP system. So essentially, with this visual, what we want to do is just picture it as it's helping to have one system at the very center, and then it's going to communicate with all the different parts of the company. So that's what the ERP system is doing. So it allows for better tracking. Yet an ERP system is going to be quite expensive to implement. So for example, Oracle is a company that creates an ERP system. So to install it is going to be very expensive, but if it helps you to be a more efficient company, then it's worth it. So that's how it works for ERP systems. So it's one system that helps us to integrate everything together. All right, so with systems, let's talk about this last kind of transaction processing system, which is for a supply chain management system. So when we think about a supply chain, we need to think about everything from getting the parts for our goods to actually shipping the goods out. So it's the entire process of how we're getting all the inputs to then manufacture our cars, etc. So this supply chain management system is going to help us organize the entire process from raw materials to production to the delivery of the product. So if we imagined a car manufacturer, then they have to purchase the car parts to make sure they have enough quantity and enough time for them. They have to then manufacture the cars, and they have to send the cars to the car dealerships. So this system would help them to kind of organize everything together. So the advantages of using a supply chain management system, one is you receive everything on time. Two is you receive it to the correct location. Three, you have proper valuation of inventory because you're keeping track of everything more efficiently, and you improve your cash flows. So once again, these last few systems we talked about have been transaction processing systems. They help you to complete something more efficiently, and that is much different than the decision-making systems that we talked about initially. And with that, I wanted us to start talking about audit data, data analytics, and what this is referring to. We want to learn a few tricks for how to memorize these elements. So we're going to have 4 different purposes of how we use data. And it's going to depend on whether we're looking into the past or we're looking into the future. And then it's also going to be determined by if we're describing what happened or if we're saying how it happened. So we're going to see those 2 major differences. And when we're thinking about data analytics, we're not talking about something very complex. Data analytics can be something that is simply running an Excel table and analyzing the information in it. So data analytics is anytime we're using data to analyze something. So imagine that we are a chocolate bar company and we are doing data analytics to see how we're doing as a company. And let's say we first want to get the descriptive analytics. So descriptive is all about describing what happened. So it's going to be for the past and to describe what happened. So let's say that we use these data analytics to see that we lost 20% of sales the past year. So this is the descriptive analytic. So you're going to notice that the 2 analytics that start with a D are going to be for looking back, and then these 2 that start with a P are going to be for the future. So the descriptive is going to say what happened, and from there we have the diagnostic analytic, which is trying to say why did that happen. So it's trying to diagnose the problem. So maybe a major competitor entered into the market. So that would be the diagnosis of what happened there. So those are looking back, descriptive and diagnostic. And then from there, we have the predictive analytics. This is when we're looking into the future and we're trying to say what will happen. So it's kind of like this descriptive analytic, but for the future. So for example, let's say our predictive analytics say that we will gain 10% of market share in the future. So it's just going to say what happens, but it's not saying how you get that specific result. So then we have the prescriptive analytics. This is going to prescribe a specific path you have to take to get the result that you want in the future. So how can we achieve a certain result? So it's the how we get to that certain future place. So in other words, maybe we need to spend more on marketing, and that way we can gain a greater market share. So that's how we can get back this market share. So once again, we have the descriptive analytics and diagnostic that are looking back. So descriptive is what happened. Diagnostic is saying, why did it happen? And then the predictive analytics and prescriptive are talking about the future. Predictive is just simply saying what will happen. And then prescriptive is talking about how can we get a certain result in the future. So that's how the data analytics work. And now what I want to do is start talking through the extract, transform, and load process, because that's pretty closely related to data analytics. So I want to address it and talk about what you really need to know about it. So this is called extract, transform, and load method. This is for data analytics, and all this is a process for how we get information from a system, how we transform it, how we structure it, get it into the right format, and then how we load it into a system to use or to store. So it's just kind of detailing that process and what we need to consider throughout the process. So it's a process that extracts information from a system, structures the information, then stores the information. So let's first talk about the extract part. So when we extract data from a system, we can either do it automatically or manually. So if you're trying to run some reports, you could do it either way. Doesn't matter how we do it. So let's imagine that we are selling an app and we're trying to export our sales data. So we could either type it in manually or do it automatically. The next part is how we're going to transform that data. Because right now, maybe we're just doing a large spreadsheet with all this information, and some of it's relevant, some of it's not relevant. So this is where we want to transform the data. So let's consider what structured data is versus unstructured data. So unstructured means just raw data and you can't use it for analysis. But once you get into the right format, then it's structured data and you can use it for analysis. So that's structured data versus unstructured data. So when we're transforming the data, we want to delete any irrelevant information. That way we can clean up the data. So if we have any duplicates, if we have any sensitive information, then we would delete that. So in this example here, let's say that we exported all of our app sales. So it tells us the app sales, the date, and the batch number. And we notice that there's a $8,999 entry, and so we notice that that's probably erroneous, and it has the wrong date too. So maybe we will delete this out. And this is the batch number, so it's probably for something for the orders, but we don't need that for our analysis, so maybe we would just delete that entire information. So we'd be left with this structured data to where we've deleted out what doesn't matter, and we've just focused on what we need to actually do the analysis. So that's transforming the data. It's getting it from unstructured format into structured format. And the last step is loading the data. So you've got it into the right format, and now you're going to store it. So you need somewhere to put it, and there are going to be a few terms that we learn for how we store the data, because we have different options for what kind of platform we're going to store it on. And then once it's stored, we can then use it for analysis. But that is the extract, transform, and load approach. And I want to talk now about those different ways that we can store the data. So we have these three different storage names. And we just need to picture what the name means and try to remember it that way. We're going to have a data lake, a data mart, and a data warehouse. So think about a lake. A lake is very large. It's very large. It holds a lot of information, right? So a data lake is where all the information is going to be stored, whether it's structured or unstructured. There's enough room in a lake for everything. So it's where everything's going to be stored. So for example, if your company is Instagram, maybe you're storing all of the text that people type in, the images that they post, the time they use on the app. So all of that would go into the data lake, and it just stores everything there. These next two terms are for when the data is already structured. And it's just going to depend on whether we want a company-wide use or if we're talking about a department-specific use. So let's take a look at this. For the warehouse, we can picture it, a warehouse is pretty large. So this is going to be structured data, and it's going to cover the company-wide needs. So picture the warehouse is very large, it structures a lot of data. Then we have the data mart, which is smaller, and so it's going to be structured data, but just for the specific needs of departments. So it's kind of like a more specific place to store the data for specific departments. So those are those three different terms: data warehouse, data mart, and data lake. All right. And with that, I wanted to talk about big data, talk about how you define it, talk about what are the different elements that you need to know about it for the BEC exam. So what is big data? Big data refers to large, diverse sets of information that are too large to analyze with normal data processing software. So we can extract very large amounts of information from the internet very easily, and we need specific software to process it. Like the example that we were talking about, if we have an app, then there's a lot of information we can track. We can track when the users log in, we can track which parts they spend the most time on, and imagine tracking that for every single user of the app, every single piece of activity. So it's a lot of information, and we need to kind of define it better and figure out whether we have quality big data or not. So we have the 5 V's of big data. We have volume, velocity, variety, veracity, and value. So volume is how much, the volume, the amount of data that we are talking about. Next is the velocity. Velocity is simply how fast the data is being generated. Is it being generated very quickly or slowly? Then we have the variety, which is, think of the variety, the structure. So what is the structure of the information? Is it structured information or is it unstructured information? Next, we have the veracity, which is the data reliable? That's the hardest one to remember because we don't typically use the word veracity in our language. So veracity is how reliable is the information. And the 5th V is value. So how much insight can the data bring? So these are the 5 V's of big data. It's kind of how we define the quality of data that we're talking about. And from there we have data mining, which is the processing of large amounts of information to discover new information such as hidden trends. So think of it as you kind of have this like pickaxe and you're mining at the data, trying to find trends, trying to find patterns and information that you can use to find new decisions to shape the direction of the company. So that's what we're considering here. And from there, I wanted us to talk just a little bit about what cloud computing is, the different terms you need to be familiar with. So cloud computing refers to the on-demand access of IT resources over the internet. So instead of storing data on your computer, you store it on the internet. So imagine that to store all of your information, you're going to use a server on the cloud. So maybe you don't want to invest in all the physical servers that you need, and instead you're just going to pay a monthly fee to store your data. So you'll have all these cost savings. So for example, if you use Google Drive to save your documents, you're using cloud computing. This is the on-demand access of IT resources. And the two main terms we have within cloud computing are infrastructure as a service and software as a service. So infrastructure, think about if the cloud computing is replacing a physical need that you have. For example, a server. That would be an infrastructure because it's replacing the need to install this physical server. And then we have software as a service, which is subscription to a service. So, for example, QuickBooks. Instead of installing QuickBooks on your computer, maybe you just log in online, and that's how you get to access your QuickBooks. So that would be software as a service. So we have infrastructure as a service and software as a service. All right, now let's head to this next term here. And we're just going to talk about the SOC reports because these are hard to understand, and I think the exam makers are testing it more and more often. So let's talk about what it is. So a SOC report helps us to rely on the test work that is already performed by another auditor. So we're thinking in the world of auditing here. So when we audit a company, we need to check to make sure that their numbers are okay, that everything looks good. But imagine that we're auditing this pizza company here, and we want to audit their payroll expense. So we're going through their income statement, and we're trying to see how much they spent in payroll expense. And they tell us, well, we don't really know because we don't process all the payroll, so we don't know anything about it. So we ask them, well, who processes it? And they say, well, we outsource the payroll to ADP, for example. So ADP is processing it every week. They are calculating the amounts. And then the auditor's wondering, well, how can I know that the number that they put out is correct? How do I know that their controls are accurate? Because I can't go to their company and do an audit of their company. So what happens is, since ADP does this service for many companies, what they're going to do is they're going to have one audit of their company, and it's going to be about all of their different controls, and it's going to say whether they're working or not. So they're going to get this SOC report. That's what this SOC report is they're going to get the SOC report, and then they give it to the auditors of this pizza company. That way they can feel comfortable with the payroll expense because it says that the auditors already looked at this ADP company. So a SOC report is trying to help us to rely on the test work of another auditor. And just to go a little bit more in depth here, you can have a SOC 1 report or a SOC 2 report based on what information you're talking about. So is it controls for financial information or for something else? And each of these can either be type 1 or type 2. So a type 1 report means that you're not looking at the operating effectiveness of the controls. So in other words, you're not going as in depth with the testing. Whereas for this type 2, you are looking at the operating effectiveness. So a type 2 is more reliable than type 1 is. And also the type 1 is looking at the controls as of a specific date. So it's not looking at them for a period of time like the type 2 report is doing. So type 2 is much better. It's because it's a more comprehensive kind of testing. And now let's look at the SOC 1 report versus the SOC 2 report. So as I said, it's all about the type of information that is being audited. So a SOC 1 report is going to refer to financial statement information. So if you're talking about controls that are affecting the financial statements, then you're talking about a SOC 1 report. So almost all the time we're talking about a SOC 1 report. But there's a SOC 2 report, and this is talking about the controls in terms of how they're operating for customer data protection. So we're looking at how is customers' data being protected. It's not very relevant for a financial statement audit, But if you are a credit card company, it's going to be very important for you to get that SOC 2 report. But we're going to be mostly dealing with SOC 1 reports, and it's a type 1 if it's looking at it as a point in time and not the operating effectiveness, and it's a type 2 if it's looking at it over a period of time and looking at the operating effectiveness. So that's how the SOC reports work. So we have been able to talk through the different topics that we wanted to address today. We've talked through different big data. We've talked through different kinds of controls. We've talked about the transaction processing systems. And so I just want to say thanks for tuning in. Thanks for learning. I hope you've learned a lot. And I will see you same time, same place next week, 12 p.m. Eastern time. And we're going to actually be talking about a FAR topic. We're going to be talking about how you do business combinations and how you do the acquisition method. We're going to talk about goodwill. So it's a very difficult section of FAR that we're going to talk about. So it should be very beneficial. All right, thanks so much.